The prospect of a trade war is more than just a prospect all of a sudden. I know you've been looking at the risks. It's pretty clear the market thinks a trade war is bad. What do you think?
Look, I think a trade war is friction in an economy where we've been trying to have, I would say borders coming down. That's what technology is about. That's what China integrating into the global economy, going all the way back to WTO in 2001. I don't believe we're going to have an all-out trade war. My view is that global trade actually peaked in 2007. Nobody's talking about that as a percentage of GDP. It went up from 1984 to 2007, and actually since the great financial crisis, it's been shrinking. I think that's one point to take into consideration. Second is that I think this really is about the U.S. was comfortable when China was the exporter to the world and the low-end manufacturing and low-end goods. Since they announced their China 2025 plan back in 2015, they've been moving up into the value-added goods. One is that's a threat to U.S. intellectual property. Two is it means they insource more, and that's what they're trying to do to create a larger domestic economy. So some of this to me is not unexpected. I think President Trump was on the tape saying that when you look at the U.S. trade deficit, about 80% of it comes from two countries, Mexico and China. And within China, it's really two things. One is technology and the other is apparel. If you believe my thesis, you'd say the U.S. is not going to do anything on apparel, which is what they announced today. And even within technology, they are allowing no tariffs on personal computers, which is the low end, but they've gone after things like semiconductors at the high end. So I really think it's about the high end. I think this is an opening salvo. I do think we've entered a new era between China and the U.S., but I'm not expecting this to be what you saw announced over the past 24 hours to be the end game. I think it's an opening of the negotiations.
So this idea that we'll have tariffs on $100 billion of bilateral trade will end up being something different? That something different looks like what?
I think ultimately the U.S. is pushing towards China opening up its market. I think that's number one. And then two is greater protection around intellectual property. If you think about today, though, if you look at global trade and you look at the growth this year, about 50 to 60% of it has actually come within the Asian region. So China has already pivoted away from just the U.S. as its trading partner and really growing its Asian business. And if you add on Asia-Europe, that's another 15 to 20%. So about 70% of the growth in global trade this year is either Europe or Asia. And so I think they probably feel confident enough that while they can have this dispute with the U.S., it's not going to totally derail their economy either.
Trade or trade tensions, let's say, are just one of the headwinds that you have already flagged for stocks, particularly U.S. stocks. What are some of the others?
So I think what we're viewing as kind of three potential headwinds to keep in mind are, one is the cost of capital, or what it costs to run your business today is going up. The Federal Reserve is by far the most aggressive central bank around the world. You and I talked about this last time. That's a big deal.
The borrowing costs are going up.
Yeah, whether it's whether the cost of your car, if you're financing that, or your house, or whatever it is. So that's number one. And with credit spreads starting to widen a little bit, that means cost of borrowings going up. That affects multiples in stocks. Two is we talked about global trade. The third, I would say, is the recent announcements around the technology sector and kind of privacy concerns. I think investors are wondering, have these companies been over-earning or using the data inappropriately? And then the final thing I would just keep in mind, cyclically, earnings revisions, and we talked about this early in the year, earnings revisions just went up to a 30-year high, and they're subsequently coming down after the tax cuts, and that got incorporated into the market. So we're in a period right now where there are no buybacks, there are no companies reporting, and revisions are going down. So our view at KKR is we're not starting a bear market. We do think that multiples for this cycle have peaked, and we think that's creating some interesting opportunities. But the period of the low vol central banks dampening any market concerns, that's over. And so I think that's a good environment for us.
When we were talking yesterday, you said something that stuck with me. A stronger economy isn't necessarily good for financial assets. People forget that, right?
I think that's one, as I travel around and talk to investors, one thing that's been missed is that we've been in a period for the last 5 or 7 years where very poor growth has led to additional monetary policy. we've shifted, and this is a secular shift away from monetary stimulus towards fiscal stimulus, with the U.S. leading the charge, but China's doing the same thing, Europe's doing the same thing. That means stronger growth. When you have stronger growth, it means that central banks will likely be less accommodative, and that will have an impact on financial assets. And I think that's just getting digested by investors. It affects multiples, volatility, things like that.
Is that why your allocation model is so massively underweight government debt?
Yeah, I mean, look, I think we've made a big bet, and I think, to date, we'll see if that plays out. To date, it's been the right call. We do think rates have bottomed secularly. We think if we're right, there's not a recession right around the corner. There are things to do with that capital and at the expense of government bonds. So in my mind, most allocators of capital use government bonds to get coupon or dividend, to get income, and to dampen volatility. They can't do either right now. That's a huge change. At the same time, we're finding lots of things in Asia to do, lots of things, we've talked about this around banks selling performing assets. So it's not nirvana, but the volatility in my mind is a good thing.
Henry, it's not like the $1 or $1.5 trillion in deficit that came out of the tax bill was a secret to anybody. It's
Right.
not like the deficit spending and the budget was a secret to anybody. Why all of a sudden did deficits matter to investors? Or at least that's what it appears.
Well, I think they matter in the context of an unemployment rate that's as low as it is. There's been no other time you can go back in U.S. history where deficits have been growing at this rate when the unemployment rate is so low, even if you go back to the Korean War, the Vietnam War. So the market looked right through the repatriation of $1 trillion+. It looked through a more hawkish Fed, and it said, focus on the deficit. And the vehicle to reflect that concern has been the U.S. dollar.
A question for you before we finish up.
Yep.
Headwinds, choppiness, whatever it is for U.S. stocks, even if it isn't a bear market, it's not a comfortable place to be. Foreign stocks may not be a comfortable place to be. You're massively underweight government debt. If there's one place for investors to find, let's call it safety or haven, because that's one of the things in their minds today and maybe in the weeks to come, where is it?
Okay. Well, if you want pure safety, cash is always the most non-correlated asset. What I've found over time is that people that try to either time the market, putting too much in or too little in, they never make money. So we're very focused on Japan. I was recently in India. There's some interesting things there on the private credit. In Europe, I would say the banks are selling performing assets. That's interesting. And we're finding lots of things secularly around the firm in the healthcare space that we think are interesting, just as long-term drivers driven by demographics, both at the high end and kind of the more millennials as well.